Baker Hughes acquires Chart Industries, transforming energy industrial technology. The energy sector just witnessed a seismic shift, and it's about to redefine how industries tackle decarbonization. Baker Hughes announced today it will acquire Chart Industries in a landmark $13.6 billion deal, merging two powerhouses in energy technology. But here's where it gets controversial. Can this mega merger truly deliver on its bold promises of accelerating the clean energy transition while satisfying shareholder demands for growth? Let's unpack what this means for the industry and why skeptics are already questioning the risks behind the rosy projections. In a move that could reshape the energy technology landscape, Baker Hughes, Nasdaq BKR, revealed plans to purchase all outstanding shares of Chart Industries, NYSE GTLS, for $210 per share in cash. The acquisition, one of the largest in recent energy sector history, combines Baker Hughes's expertise in rotating equipment and digital solutions with Chart's leadership in gas liquid molecule handling technologies. Together, they're positioning themselves as the Swiss Army knife of industrial solutions, from liquefied natural gas (LNG) infrastructure to futuristic hydrogen projects. Why this deal matters more than you think. Chart's portfolio reads like a playbook for modern energy challenges. 65 manufacturing sites producing cryogenic equipment for everything from data center cooling to carbon capture. Proprietary uptime digital platform for predictive maintenance. Think Fitbit for industrial equipment. $4.2 billion in 2024 revenue, with a staggering 23.8% adjusted EBITDA margin. But here's the twist most analysts overlook. This isn't just about combining products. The real game changer lies in creating closed-loop lifecycle solutions. Imagine a wind farm where Baker Hughes's turbines work seamlessly with Chart's hydrogen storage systems, all monitored through integrated AI. That's the endgame. The billion-dollar synergy question. Management promises $325 million in annual cost savings by year 3 through 1. Supply chain consolidation. Think bulk purchasing power. 2. R&D efficiency. No more duplicating similar projects. 3. Service network optimization, using Baker's global footprint to boost Chart's maintenance reach. Yet critics argue, at what cost? The $13.6 billion price tag represents a 9 times EBITDA multiple. Aggressive for a company in cyclical markets. Can Baker Hughes's much-touted business system truly offset integration risks in 65 global facilities? Decarbonization meets profitability. Can they coexist? The companies paint an ESG-friendly picture. Combined capabilities in carbon capture utilization and storage, CCUS. Enhanced LNG solutions to replace coal in emerging markets. Hydrogen infrastructure development for heavy transport. But here's the elephant in the boardroom. Will shareholders tolerate short-term margin pressures from R&D investments for long-term climate gains? The projected double-digit EPS accretion in year 1 suggests they're trying to have both, a delicate balancing act that's already sparking debate. The financial tightrope walk. Baker Hughes plans to fund the deal through bridge financing from Goldman Sachs and Morgan Stanley, aiming to reduce net leverage from 2.25 times at closing to 1.0 to 1.5 times within 2 years. The strategy hinges on maintaining dividend payouts during deleveraging, divesting non-core assets, those specifics remain vague. Banking on Chart's high-margin service revenue, 30% of its business. Controversial take alert. Some industry watchers argue this deal exposes Baker Hughes to overhyped sectors like hydrogen, which still lacks scalable infrastructure. Are we seeing visionary leadership or a $13.6 billion gamble on technologies that might not mature for decades? What's next? The transaction faces standard regulatory hurdles and a Chart shareholder vote, with closure expected by mid-2026. Key dates: July 29th, investor call details available at investors.bakerhughes.com. Chart's proxy statement filing in coming weeks. Your turn to weigh in. Do you see this merger as A, a masterstroke in energy tech consolidation? B, an overpriced bet on unproven markets? C, too early to call? The real test comes in integration. Sound off in the comments. Let's get contentious. Politely, of course. Full disclosure. Chart shareholders receive $210 per share cash, 38% premium to 30-day average. Baker Hughes maintains A credit rating target. Leadership teams emphasize cultural alignment. But let's revisit this in 18 months. For skeptics, optimists alike, the A6-page forward-looking statement section reads like a thriller novel of potential risks. From regulatory roadblocks to the haunting phrase, difficulties in retaining relationships with employees. One thing's certain. This deal will either become a business school case study in strategic brilliance or a cautionary tale about the perils of scale. Baker Hughes nears $13.6 billion deal to acquire Chart Industries, outbidding Flowserve. Imagine a $13.6 billion deal that could shake the very foundations of the oil and gas industry. This is exactly what's happening as Baker Hughes nears a massive cash deal to acquire Chart Industries, leaving rival suitor Flowserve in the dust. But here's where it gets interesting. This potential acquisition is not just about expanding Baker Hughes's portfolio. It's about the company's bold move to dominate the natural gas and LNG sectors. As the energy landscape continues to evolve, Baker Hughes is making strategic decisions to stay ahead of the curve. The company's CEO, Lorenzo Simonelli, has been working tirelessly to reshape Baker Hughes and adapt to the global energy transition. This involves shedding non-core assets and investing in cleaner energy solutions, a move that's both forward-thinking and potentially lucrative. A potential deal with Chart Industries would not only displace the company's previous agreement with Flowserve, but also mark a significant shift in the industry's balance of power. The original deal between Chart and Flowserve, valued at $19 billion, has been terminated, according to the Financial Times. This consolidation wave in the U.S. energy sector has already triggered $250 billion worth of deals in 2023, but it's been slowing down since the end of last year. So what does this mean for the industry as a whole? Baker Hughes's decision to make a higher bid for Chart has forced the latter's board to reconsider its deal with Flowserve. The proposed deal would value Chart's equity at $210 per share, a 22% premium to its market value, giving it an equity value of about $10 billion. But here's the question. Is this deal a smart move for Baker Hughes? Or is the company taking a risk by investing in a sector that's still evolving? And this is the part most people miss. The potential implications of this deal go far beyond the companies involved. It could have a ripple effect throughout the industry, influencing the way companies approach energy production and distribution. As the energy sector continues to navigate uncharted territory, one thing is clear. This deal has the potential to be a game changer. But what do you think? Do you agree that this deal is a strategic move for Baker Hughes? Or do you think the company is taking a risk? Share your thoughts in the comments below. As we wait for the official announcement, one thing is certain. The oil and gas industry will be watching this deal closely, and its outcome could have far-reaching consequences. The fact that Chart's stock climbed more than 17% to $202 in aftermarket trading is a clear indication that investors are taking notice. With a market capitalization of $7.71 billion as of Monday's close, Chart Industries is a significant player in the industry, and its acquisition could give Baker Hughes the edge it needs to dominate the market. But as we consider the potential benefits of this deal, we must also acknowledge the potential drawbacks. The energy sector is known for its unpredictability, and any major deal comes with risks. So, the question remains, will this deal pay off for Baker Hughes, or will it prove to be a costly mistake? Only time will tell, but one thing is certain. The outcome of this deal will be closely watched by industry insiders and outsiders alike. Chart Industries, when a done deal comes undone. Stock analysis. When a deal is signed, it's easy to assume it's set in stone, until it's not. Chart Industries' recent saga of a done deal unraveling has left investors questioning the fragility of even the most carefully planned agreements. But here's where it gets controversial. The same company that once promised stability now faces scrutiny over its financial decisions. This isn't just a story about corporate missteps. It's a lesson in how markets can shift overnight, leaving even seasoned players scrambling. Author's disclosure. This article was crafted by me, reflecting my personal views. I hold a long position in GTLS through stock ownership, options, or derivatives. But I received no compensation beyond Seeking Alpha's platform. No business ties exist with any companies mentioned here. Disclaimer. I'm not a financial advisor, and this piece isn't meant to guide stock trades. Investors should review company filings and press releases to align with their own criteria. Remember, past performance doesn't guarantee future results. Seeking Alpha's note. Our analysts are independent contributors, not licensed professionals. Opinions expressed here may differ from the platform's overall stance. Always consult your financial advisor before making decisions. And this is the part most people miss. The human element behind the numbers. When a deal falls apart, it's often not just about spreadsheets. It's about timing, risk tolerance, and relationship to work. And the unpredictable nature of markets. What do you think? Are we overreacting, or is this a sign of deeper issues? Share your thoughts in the comments below.